All right, welcome to the FreightWaves SONAR 301, more advanced sections of the SONAR data. I am your host today, Zach Strickland, and I will be digging into our Truckload Carrier Association benchmarking data. Just to give a little bit of a background on what the TCA benchmarking data is. It is a lot of operational and financial metrics that are combined to help reveal more about what's going on in a truckload carrier operation. It does not measure any kind of brokerage percentages or any metrics of that sort. It does measure brokerage as a percent of revenue and their contribution to a carrier, but we all know that those brokerages are not exactly the same as, say, an Echo Logistics, which is a pure brokerage, or something to that extent. This is strictly a truckload carrier type indice. It is for the carriers out there that are looking to figure out where they stand in the bigger picture of the rest of the country. Inside this data is a multitude of different types of carriers. We focus on flatbed, dry van, and reefer in this data, and they all have at least 50 to 60 representatives from each segment in the data here. So I'm going to go through these, not in their entirety, but I hope to give at least a better understanding of what you can get from some of this data. So I've got the Knowledge Center pulled up here for the TCA Benchmarking Indices, and you can get to this by simply going to FreightWaves and then clicking on SONAR and getting to our Knowledge Center that way. Or inside of SONAR itself, there is a little help button with a question mark on it. You can click on that, and that will take you to this page. So, and then you will click on TCA Benchmarking Indices, which will take you here. So here you see a list of what's available for the TCA Benchmarking Indices. I'm going to go through some of my favorites just because I think they're a little bit more useful, but all of them are going to have use to, different people. They're not necessarily going to be, the ones that I'm going to look at today are probably going to be, the ones that I would target for the majority of the carriers out there from my perspective. But there's also going to be a lot of use cases for very specific, needs as things change in the industry. So just walking through some of these, some of my favorites, this length of haul, I think everybody's familiar with. That's the one I'm going to start with first. So going into our SONAR platform here, go up to, where'd it go? I'm just going to open up. Well, I lost my SONAR page. I'm going to go ahead and just open it. It's taking it away from me. Where did my SONAR page go? Oh, I need to stop the slide share. There we go. All right, there we go. SONAR. Back at it. So to find our TCA benchmarking indices, simply click down into the search field. Even if you don't memorize these, I don't have all of these memorized. TCA benchmarking indices right here, click on this button, and then it will open up, all your indices that are available. The average length of haul, again, I want to start with this one because I think it's one that everybody tends to use. They like seeing this. And you can see here that there are some, tickers next to it. Aloha FCF, Aloha FCF, FOO. You can see down underneath it, those are the explanations. Well, you're going to ask, what is a company fleet? What is a leased fleet? Well, company fleet are the drivers that you have on your payroll that are under your benefits. You control that, you force dispatch. They're not contracted carriers. Lease fleet are your owner operators that you may have on some sort of contract. They don't necessarily work for your company or the company in general. They're going to have a little bit more flexibility, leeway, not necessarily bound to that carrier. So that's important in the way that those numbers are going to fluctuate over time, which there is a TCA Benchmarking Index available for that called owner-operator percentage, and that's going to give you a pretty good idea of how many owner-operators are in any given fleet at any given time. These are all monthly indices, just so you know, so you can check on them every month to get what the industry is doing. So Aloha, FCF, VCF, RCF, flatbed, reefer, dry van, and I'm going to focus on the dry van because that is the majority of the carriers in the country. Average length of haul, simply a measure of how long they drive on any given load. So right now we're looking at about 532 miles per load driven in the month of August. We have not closed out September. That's why you see that big gap there. But you see that over time, when length of haul changes, that's a different dynamic. So if your length of haul is going up, that tends to mean that you're going to get more miles, but it's also going to mean there's going to be a little bit more volatility in that sector because the further you drive, the harder it is to refill that capacity in any given market. The longer haul loads tend to deplete capacity faster. Your shorter haul loads, like your local moves 0 to 100 miles, 200 miles even, you can do those in a day and get back to where you came from. A lot of truckload carriers will charge a minimum. Knowing that fact, regional carriers, for instance, don't necessarily like to see an increasing length of haul. Some of your longer haul over-the-road carriers certainly enjoy seeing increasing length of hauls as well. So over the last couple of months, we've seen an increasing amount of length of haul. So decent sign for over-the-road. They do pay a little bit more, obviously, but something that the industry has been tracking over the last couple of years is this idea that the length of hauls are shortening. That's actually not entirely accurate. It's not one or the other. It's actually doing both at the same time. We've tracked some data, that we'll actually be releasing in SONAR here in the near future that will give you a better picture of this. We actually have an outbound average length of haul sitting in the regular SONAR data. So don't get confused with this if you're looking for benchmarking, but I've simply put an O in front of Aloha, and then you can look up every single market on here, and you can see the average length of haul for individual markets. Well, maybe not today, but we're also going to be releasing this in the next couple of weeks where you can actually see, by regions and all sorts of granularities of the average length of hauls. Aloha.VCF or VCFOO will give you a combined idea of what's going on in the general industry. Our data, our tender data, is what's backing the OAloha and iAloha data. That's going to tell you what's going on in the general marketplace, but this is going to be specific to carriers. The next one I want to go through, if we go back, I want to try out OPRAT. So OPRAT is one of my favorites. It's one of the best indices to look to see how is the industry doing in general. It's basically the end number of what's a carrier looking to accomplish. Over the last several months, this year has not been great for some of our carriers out there. More trucking failures than in recent the last 2 years or so. And it's because they're operating less efficiently than before. The operating ratio is basically a measure of how efficiently you're spending your money in the operation. It doesn't include things like capital expenditures and stuff like that. No taxes, no interest. It's basically going to say everything that I spend money on to move a truck across the country or service, the main portion of my business, which is getting the freight from point A to point B as efficiently as possible. And if you are under 100, that means that you're making at least some money on that. It doesn't mean that you're profitable entirely because there's other expenses involved on the income statement that aren't involved in this. But effectively speaking, things like maintenance cost, tires, driver wages, back office wages, anything like that is involved and necessary for the day-to-day operation is included in this number as an expense. So you're seeing right there that it's a 99.03 out of 100, or actually you can actually go up as far as you want. Anything over 100 means that you are losing money on your operation, which means that you do not have a prayer of making money in general, unless you have some sort of investment sitting out there, which most of you do not. That's pulling in revenue outside of this. Now, a 99 OR isn't necessarily a great operating number. It means for every dollar spent on the operation, you are making 1 cent on that dollar. So again, most carriers out there have some form of leverage involved. So debt and interest expenses are not involved in this. So more than likely, a lot of these carriers are not making money right now due to the fact that they do have, leasing payments on warehouses or store or facilities or something out there, or maybe just they're funding their business that they, to get going. They had to take out a loan to get started or to get moving or make some sort of other capital expenditure, investing in the fleet, whatnot. Those are not included in here. So that's typically more than 1 cent per dollar spent. So that is not a good sign for carriers out there right now. Operating ratios being, you typically want to see them at least 95 or lower. Some of your best carriers out there, such as Knight-Swift, operate in the 70s right now, which has been unheard of, but they've managed to really catch fire in terms of 2018 and 2017 has really push them forward, and they've been able to take advantage of it. So operating ratio, a great number out there to look at for anybody interested in knowing just how well you're doing. Use case for this is basically, we were operating at a 93 last year, and now we're operating at a 96. I go out to my operating ratio, and I can see clearly that, market trends are showing that everybody's having a similar situation. We have lost some headwind from 2018, and that's not unexpected. A lot of that has to do with lower volumes, as well as increased supply in the market, creating a little bit more competition. So anyone out there looking to see just how well they're doing versus the market, this is a great number to look at for you. Another one that I think is pretty relevant. So operating ratio is a good high-level number, but driver revenue per week, revenue per driver per week is also a good metric to look at in terms of just trying to figure out how efficient your driver activity is. So your sales team is going out there, they're getting customers, they're booking loads, they're making sure that, you have some sort of contracted freight moving at all times. The higher the revenue you get, this is also a measure of, pricing to an extent, not necessarily pricing efficiency, but operational efficiency with that driver and that revenue efficiency with the driver. So the higher the number, that means that your driver is making as much money as possible as he can. When this number goes down, that means that two things are happening. Either he's not moving as much freight or he's moving freight at a lower price, lower rate. In 2019, a lot of people should be operating on some contracts that had some benefit of 2018. We did see these numbers come up over the last little bit. You see 2018, we had two things happening. You had increased pricing power on the carrier side, and you also had increasing volume. So that means that these drivers could get in and out of facilities with loads a lot more efficiently or a lot better because there's more availability of loads in 2018. But also, they were able to increase their rates for the first time in a very long time. So they're going to have a double impact on that. And you see how there's a little bit of stickiness here coming out of 2017, 2018, and then it still stays high, even though volumes have come down a little bit over the last bit. And that's because probably due to the pricing. A lot of these annual contracts stayed in place. So they did have some increased, at least for the near term. We'll see how sticky they are in 2019. But at least this year, they did have some stickiness to them, which is probably another reason why Knight-Swift and some of these other carriers have kept pretty low operating ratios. Some other TCA benchmarking indices, because the point of these is simply to just show you how are you stacking up against the industry. That's what benchmarking is. We have empty miles and a lot of these metrics that they don't necessarily give you a direct measure of revenue, but they give, or success or operational efficiency, but they are telling you what portions of your your operations are acting correctly. Empty miles, again, this is a good one to look at in terms of, how efficiently am I able to source my freight? How effective can the carrier be when, if maybe our shippers are spaced simply too far apart, our consignees and origins are simply not positioned effectively enough. That's what an empty mile is going to be. So anytime that you're finaling a load sitting in Bismarck, North Dakota, you typically have to deadhead, which is what an empty mile is, several hundred miles to go get another load unless you have a shipper or an origin in that area, which hopefully most people do, or they've at least built it into the rate. So like I said before, there is a pricing aspect to this that isn't visible on the empty mile, but it is going to tell you how efficient are you being with your freight movements, because there's maintenance costs and other things involved with moving that truck. Empty miles, non-revenue miles, are very painful for a carrier to deal with. Empty mile percentages going up mean that they're having to deadhead a lot more to source their freight. You can see here that 2019 has not been great on the empty mile. You can see the clear correlation between operating ratios and the driver revenue going down, operating ratios going up, driver revenue per week going down, and empty miles going up. All these things are coming together to contribute, and they're painting a picture of a lot softer market. Also, carriers are just not able to be as efficient as they were in 2018 when the market was booming. You can see here too in 2018 though that empty mile percentages were still up over 2017. It's because they could afford to do that. They had a lot more pricing power, so they could build this into the rate. That's another aspect of empty miles that you have to keep in mind, is that any load is good as long as the pricing's right. I used to be a pricing person and I had to hear that all the time. The problem is that the market itself may not bear increased pricing. So you can fix anything with increased revenue, but in the market we're in now, you cannot simply get away with building these empty miles and deadhead percentages into your rates as you could in 2018 when you had pricing power. Right now, we're entering a very soft market. Going down the list here for a few more. I think brokerage percentage revenue is a pretty interesting one. These are going to be broken. These are basically the percentages of the revenue of the company that is driven by brokerage volume. And these are going to be asset-based carrier brokerages. So there's a different aspect to this, because a lot of the time you can move revenue in buckets between the brokerage and the asset-based side, depending on how you want to allocate this revenue. Now, most of our people do try to keep this as pure a number as possible in terms of this is something that the brokerage team brought on. But as we all know, a lot of the asset-based guys will take some of that brokerage resource and use it to help source freight for them, and vice versa. There's a push-pull effect here. But as the brokerage revenue percentage increases, that means that there's two possible things here that are happening. That means that the market itself is super volatile and everything is going haywire like it did in 2018, or that carrier needs to source more of its freight outside of its sales team. So it's going to be a little bit of a dichotomy here, but you can see clearly that the brokerage revenues have been elevated over the last bit. I think a lot of that mostly has to do with the fact that 2018 was booming, a lot of spot market exposure, which is a lot of what the brokerage revenue is for an asset-based carrier. Asset-based carriers don't necessarily want to have too much exposure to the spot market, so they can leverage their, maybe some slowing revenue on the asset-based side with brokerage revenue, outsourcing to other carriers and whatnot. This makes them more able to service their existing customers. Moving forward, I just want to go down the list with a few of these, just to make sure that there is, there's enough here that I think most people can see. Some of these are pretty self-explanatory. Net revenue per truck per week is another good one to look at in terms of, it's similar to the driver revenue, but, you can have a lot of trucks that are inactive. Whereas drivers, you can't just simply inactivate. Certainly you can put some on furlough, but nobody likes to do that because that means that driver has an opportunity to go to another place, which is very hard to do, especially on an asset-based carrier side, to recruit another driver. So the truck per week will give you an indication of how many assets you have available that are simply sitting and not being used effectively. Net fuel expense percentage and net fuel expense per mile, they're both similar in the way that they're telling you how effective your fuel spend is. So it's not necessarily a measure of, direct fuel expense. It's net fuel expense, which is your fuel spend less the fuel surcharge that you are charging your customers. So anytime that you see these going up, that means that carriers are being a lot less effective in their fuel spend. So you can see here that the dry van carriers have about a 7.8% net fuel expense percentage. That's not great. Industry average runs from 5 to 10 in general, but it's simply such a volatile market for fuel. They're having trouble basically sourcing their fuel and making sure that it is not impacting their bottom line. It only takes a few percentage points to knock down that OR because you do have to spend, if you're spending too much on fuel and not able to manage it, that only takes like 1 or 2 cents off the dollar, but that's all you need. That's the big difference right now between being profitable and not. 7.8% is not a great number. You want to keep that one down in the low sixes for sure. 5 to 6 range would be ideal, but we can see that that's not always attainable. This right here is a good indicator of how some of the carriers could potentially save a little bit more money with a little bit better fuel management situation. Increasing fuel surcharges is one way, but also being more efficient and buying a better deal, obviously, if you have the opportunity, which not everybody does. But again, it's going to tell you, hey, we see this item on the income statement. We go look at it, and we see that we're spending about 6% net fuel expense. We're doing really well. Let's see. There's the owner-operator driver percentage. This is going to be the one that I was talking about earlier. Owner-operator percentages can go up simply when you think you're going into a flex period where volumes are going to increase, or simply you think that maybe the market's turning down. I want to increase my owner-operator, my variable cost here, because owner-operators, you can shed those a lot easier than you can a company driver. This is going to be in that leased fleet segment that you see on a lot of these indices. And you can see clearly this year, the owner-operator percentages are increasing. That can be from a number of reasons. The most likely is the fact that these guys are trying to build up a fleet that they can be a little bit more flexible with. Obviously, 2018 did not carry into 2019 as hard as most carriers would like. So having a bigger fleet of owner-operators makes sense on the variable cost side. That's something they can manage a little bit easier. Big driving upward movement in here, but that also means that some of these company drivers may have fallen off and they simply just chose to replace them with owner-operators. Like I said, easier to flex up and down with an owner-operator fleet versus a company driver. A few more indices here. So insurance expense, dive into this one real fast. Insurance is, I think everybody knows what insurance is, but there are some notes to point out here for insurance expense, especially for the financial analysts out there listening or interested in this data. That's going to be something that people are going to put reserves on, just to throw out an accounting term. So any given month, these guys can go out and place X amount of dollars. They don't necessarily all have insurance, but a lot of them will put this insurance reserve cost out there. So they're going to sit it in their income statement, basically making sure that they have money for if they do see an increased risk of accident or some sort of lawsuit. I think we all know that there's a lot of stuff that happens out on the road. 3.78%. You can measure these as seeing obviously carriers are expecting to pay a little bit more here in the next year or so, or over the last year, they've paid a little bit more in the insurance cost side. And again, a great number to monitor moving forward, as insurance costs appear to be a pretty big pain point. Along with insurance, there's also maintenance costs that I will dive into and show real fast. Maintenance costs, again, one of those pain point line items on the income statements. And you can see maintenance costs hovering about where they've been, but I believe they've come up over the last 2 years, and they have. A lot of this could be, I mean, again, when you have an aging fleet, your expense per mile is going to go up. Maintenance costs, one of those big, but again, all the vendors out there that are responsible for maintaining your trucks have also taken increases. We have a lot of new fleets that entered or a lot of new trucks that entered the space in the last year. That should drive maintenance expense down, but it has not had that impact. We're actually seeing maintenance expenses going up over the last year or so. So I think, real quick, you can obviously click on here for the Knowledge Center, but I wanted to point out one more thing. I did not go through all of these indices, but be sure to go ahead and click on any of the TCA benchmarking data. I think most of them are self-explanatory, but they're not all as clear as I think some people would like. So if you do click on one of these, make sure to click this View Symbol Information, and it'll give you a quick rundown of what this is, a description. But if that's not enough, it will also link you to the View Knowledge Center if you click on that. And it'll give you a little bit more in-depth description of what it's doing there. So from here, I will just go ahead and open it up to any questions that anybody might have. And if not, everyone have a great day. All right, since there's no questions, that'll end the TCA Benchmarking Data webinar. Hope everybody enjoyed it. And if you have any questions, feel free to reach out to FreightWaves. Thanks.